Welcome back, everyone, to another Friday Night Market Conversations. I am excited. Tonight is going to be fun. A Twitter favorite of mine who runs a daily live stream, Mr. Noah Seidman, is going to be in studio, and we're going to have a discussion about risk. This is an interesting topic in that I can tell you personally, I spent most of my life being completely unaware of the financial risks that I was taking. And it wasn't until I got into crypto and started becoming financially literate through my other studies that I realized these can have pretty major consequences. You know, many of us have heard about the scams, right? Many of us have heard about people who have allocated improperly. Many of us have heard all the horror stories as it pertains to loss of asset through counterparties that go belly up or bankrupt. And so this conversation is going to be really interesting. You know, I have been looking at markets and seeing this distortion, right? The distortion between what I would call, I call it the bifurcation of Main Street and Wall Street. You know, when I look at Wall Street and I'm looking at record valuations and I'm looking at companies like Tesla, you know, who's going to be the 7th largest company in the United States. It's going to be on the S&P 500 starting on Monday. The element of value that seems to be coming from where? Where is it coming from? When businesses all across the country are closing, unemployment is absolutely insane. Municipalities are underwater, not collecting enough taxation to pay their employees, right? You would think we're coming out of a pandemic, yet Wall Street is soaring. So there's this big bifurcation between Main Street and Wall Street. A lot of that, I think, has to do with the fact that risk in the debt market is driving this. We're going to start off with a discussion about what the risk-free rate is, and we'll build from that. So let me bring in one of my favorites, a guy that I've learned a ton from and really enjoy my interactions with, Mr. Noah. Hey, Noah, how are you tonight?
Good evening. Always a pleasure.
Great to have you back on the show. So I wanted to, let's start this discussion off about risk and take a look at, in capital markets, there is a thing, it's a term, it's called the risk-free rate. And it is a signal as this is the most pristine, safest place for your money. It has the fewest amount of risks associated to it. That happens to be, and has been for many, many, many years, the treasury bond market. And it's risk-free mainly because the United States has the largest, most well-funded military on the planet. And if you don't like what we do, we have a tendency to not help you when you need help. So if the risk-free alternatives for us investors are assets like bonds that will pay us next to nothing and sometimes even cost us to own them, everything else would therefore be risky. Let's dive into how you think about this, and we'll just riff from there.
Sounds good. The first thing that comes to mind is Stephen Van Meter.
Oh, I love him. I love Stephen.
He is so enjoyable to watch. A wonderful personality, and he's absolutely brilliant. Just this space and what many folks talk about real vision, bringing personalities to surface, and Twitter really of late. I don't think this is historic, like going back 3-4 years. Is it more recent, 1-2 years? The surfacing of personalities is just has changed everything. So he talks about, so the treasuries are, the rates are basically zero, likely going negative at some point, as Raul will say. But Stephen puts forth that you could potentially have asymmetric returns in the bond market. So it's not necessarily just a casual play, all things considered from the macro financial perspective. It's not something that I expose myself to because I'm not a historic or traditional markets player. I'm relatively towards the younger side, definitely in age as well as investing expertise. I do dabble in the equities markets, but the 184% market cap to GDP, yeah, you could just keep going, but the upside has max risk, min reward. I tend to think in extremities. I don't have the traditional financial background, but I'm able to observe when something is relatively risky relative to something else, usually something that's either less or more risky. So everything is relative, and that's how we're able to get a baseline, a perspective on a relative risk. So bonds, from everything that I understand, from everything that I hear and learn from the smarter people in the room, great place to park money. You're not going to get yield, which kind of means so that's a lot, something I think about often. It's a perversion. So I want to buy a bond because I'm going to get yield, an interest rate. So I don't want to buy a bond because it's going to go up in price. So that kind of sours it from not an honorable perspective, but from like it's disturbing. So that's not where I park my value. That doesn't make logical sense to me. So you guys know where I park.
It is interesting. I want to just take real quick. Let me go back here because obviously the folks are piling in. Scorpion, great to see you. Julius, Tony, good to have you, man. Pete Kelly, always a pleasure. Wade, nice to have you, my friend. We got Argo Glass. Deep Precise, nice to have you. Hey, Stephen Kurtz in the house. Ellie Poole, and one of my all-time favorites, Vet Bro. Good to have you, man. Guys, I say throw in your questions. I think one of the wonderful elements here is that to demystify this really kind of deep rabbit hole of trying to understand capital markets, as an investor, all you really need to do is understand, okay, when I'm doing risk analysis, something I felt comfortable with in the past measured with something new I'm about to dive into, how divergent is that? How different is that? And what are the mechanisms in play here, right? Take away, like if I'm looking at a digital asset, I'm not necessarily looking at Bitcoin, this or that as a specific project. I'm looking at what kind of protocol does it have? What kind of market presence does it have? What kind of community does it have? It doesn't, it does. These are the things that seem to matter, because now we're in a world with these digital assets where what drives quote unquote valuation isn't political policy, it's network effects, right? Very important distinction. When you look at what's going on in capital markets, any traditional way of evaluating a company where you're looking at forward sales and cash flows and discounted earnings and how much debt are they carrying and what intervals is that going to be serviced at, and etc. All these traditional metrics to value companies don't seem to be relevant anymore. We've entered this new world, and I firmly believe it's because the cost of credit is so cheap. The ability for a company that has any kind of valuation to issue a bond against their value to get more capital to deploy in whatever way they want, whether it's buying back their own stocks, which seem to be what they do. They're definitely not investing in R&D. You know what I mean? They're not. It's scary. So we have this beautiful digital asset space. Talk to me about how, why you've gone like hook, line, and sinker into this, because you're not dabbling in the stock market. You're in the crypto space, and you talk about it every day.
So I do have a history of the equities markets, and I got I'll just in brevity, like 2016, 2017, I went deep into battery metals, way before Tesla, and
Lithium.
as lithium, cobalt, nickel, and graphite.
Oh,
And 2017 was fire. It was just an absolute just bull market, and everything was up huge. And then 2018, it just absolutely collapsed. And it's such a heavily manipulated market, and everything in the, whether it be crypto or traditional financials, everything is heavily manipulated. And this year, more than ever, I've grown to distaste traditional markets more than ever. One of my largest investments ever was Namaska Lithium. They had like $1.3 billion in funding that they acquired. This is the largest funding of any lithium mine and refining project in North America. This is the most important refinery in North America, up in Canada. And they ran out of money and they went bankrupt. And the private investors came in, snatched up the company. All the retail stock is gone. So it's cutthroat. And that's just pure manipulation. And with the pandemic going on, this is what they did. This was the ruling of the Canadian government to cut out retail and deem that that was acceptable. So I just have a complete distaste for it nowadays. Albeit I still have, as I've become almost entirely risk off as I define it, I have small percentages of my portfolio allocated risk on to still to battery metal plays. With regard to traditional equities, I'll finish with definitely gold miners, streamers, and IRA custody precious metals, gold and silver. So that's the name of the game for the old school stuff. But crypto is definitely risk on, even Bitcoin, relative to gold and silver and big bonds. But in the crypto space, Bitcoin is risk off. So see, it's all relative. And then it comes down to asymmetric return potential and also biases and passions. So it's hard. You can't eliminate emotion. We're human. So my emotion has pushed me to be predominantly into Bitcoin. From basically just the overall portfolio perspective, predominantly. Let's just say that. And then then you have the rest of the crypto space, which is risk on relative to Bitcoin. And then that's where we get into a risk analysis that we can talk about and how we look at these projects.
Well, let's do that in just a second. So there's a few folks. Heirloom, Lori, Simon, great to guys have you. Joshua, good to have you in the stream. If you have questions for Noah, just throw them up, Brady. You'll put them on the screen. One of the, so this is interesting. This had to be, and Brady, correct me if I'm wrong. Brady is great helping me out here. I think it was about June or July when we launched this show. And from the moment I launched this live Friday night conversations, I was always very open that I have this, I have a portfolio of digital assets, Cardano, XRP, weighted, it goes XRP, Cardano, and I really didn't have much exposure to Bitcoin, but I saw the market from a macro lens and went, you know what? You guys do what you want to do. I'm going to put every dollar into Bitcoin for the unforeseeable future. And I've maintained that investment strategy, and I will continue to dollar cost average into Bitcoin until I don't. But it is like there is such a macro narrative behind this thing right now that, I don't see an end. And until I see an end, keep going. And for me, that's the risk on, where I see a tremendous amount of other people talking about, well, Bitcoin is at all-time highs and exceeding all-time highs, yet there are these wonderful projects that in their view still seem undervalued. And there is a case to be made. There's an argument on both sides of that coin. I'd love to hear what your specific thoughts are, unless there was a question I missed. Brady put something on the screen that it looked like it was a question. Brady, could you bring that back up?
No, I'm definitely not done with an IRA, albeit when the pandemic hit, the early withdrawal penalty from the IRA was lifted. So yeah, and miners are cool too. So a couple have actually gone bankrupt since Namaska. So, but it's still risk on. On my show, your bets, your gambles 1%, less than 1% of your portfolio, because if 1% turns to 10%, it changes everything. You don't need 30% into risk on to change your life. And then the whole don't spread too thin and don't go all in too thing. But the point being, crypto. That's where the excitement is. And as Jerry says, Bitcoin is the thing to accumulate until the story changes, and the macro narrative is there. The institutions are here. Raul and Novogratz talked recently, and just some of the stuff on Real Vision's absolutely.
I'm a huge fan.
It's more than invaluable. These are the people making the biggest financial decisions on the planet, and we get to hear them speak. And we've gotten to hear some of the largest hedge fund managers that even are on Real Vision on the news lately.
Yeah.
It's just, this is the obvious story, the obvious course of action. And as you said, until the story changes. And if the story changes, you have to adjust and do different things and make different choices. Never go all in, Pete Kelly, never go all in and never spread too thin. So that's just the phrase, words of wisdom. And this goes into portfolio balance and how you think about crafting and structuring and balance and position sizing, so on and so forth.
And then what is at the basis of all this, right? Every single person has a different risk tolerance.
Yes.
And that is like that's why this is such a perfect topic. Hey, BZ, good to have you, man. Good to see you pop in. So when I looked at this, I was coming from the lens of an over 50-year-old person who made a decision to get out of the game and retire. And if nothing good happened to me, then I would drag out a $350 a month existence for the rest of my life down here in Costa Rica and, fade into dust. But I had some capital, and I thought to myself, I got $50,000. Where else can I put $50,000 that I can make a real bang? Because I'm looking at capital markets in 2016, 2017, and I'm going, I don't know, but that's where my money was. And come 2018, when I found crypto, I went, this is it. I'm going to swing for the fence. Now, that's a high risk play, but I understood so it's, I'm going to risk 50 to make $1 million, right? And the downside is if I lose it all, I live on my little $350 a month annuity down here in Costa Rica for the rest of my life. And oh, well, it's beans and rice and learn Spanish, because you know what I mean? There's not going to be any traveling going on. So that's the risk to reward. And every single investor should understand where they are in that, where their risk tolerance is. What are you willing to risk to get this? And is that reward worth the risk? And if you understand both sides of the equation, then at least you're taking a responsible approach, because everybody's going to have different goals and needs. And therefore, their portfolio should be crafted to produce the results of those goals. Right? I love it. What now?
More isn't a goal. More money. You want 10,000%. That's not the goal, guys.
It's not for me. What do we got here from Steven? I think XRP isn't that big of a risk relative. Well, Steven, XRP is a huge risk. Can Michael Saylor put XRP on his corporate balance sheet? Can Mass Mutual buy XRP? No, it's not big enough yet. Doesn't have a big enough market cap for any institutional investor to start gobbling it up. So we are 100% reliant on utility. It's a risk I'm willing to take because I think the utility will come, but it is not risk-free.
And you don't need to make the big gamble, because 1% turns into 10%, that changes everything. And if you have 5 assets where 1%, because it's not just going to be 10%, that's why the crypto space has so much potential, because these assets, when you're talking about the global total capital of several quadrillion dollars, it's not going to be 10x's. You make calculated and well thought out choices, these are going to be 100x's. 1,000x's. If XRP fulfills the prophecy of a payments network, it's not going to be at 10x. It's not going to go to $4 billion to $40 billion. It's going to go to $4 billion to $400 billion or to $4 trillion. And Bitcoin is going to be a $100 trillion market cap. So you don't need 30% of your portfolio allocated to non-Bitcoin. And even here's the kicker: with the smaller risk on assets, or the non-Bitcoin risk on assets, as those appreciate in price, you want to accumulate more Bitcoin, because the narrative for Bitcoin is it's a pristine collateral asset, as best said by Raul. So now you're generating a revenue stream by lending your Bitcoin. And now, and the goal being, so at least it's my goal, and it's a recommended goal. I'm not a financial advisor, but it's a logical and rational recommended goal, that if you accumulate enough collateral, you can generate enough of a revenue stream to replace work with money working for you. And that seems like probably the best goal for a human being.
Have you been watching my channel lately, Noah?
Good minds think alike.
Well, I'm telling you, that has been the field of study I've been in, diving deep. And the reason, the concept is easy, right? Collateralize for passive income. That's a very easy to understand. I have $100. I'm going to put it here, and I'm going to receive $5 a year on that $100. Scale it up. You can see where that can go, right?
Yes.
Well, I have taken that to a whole new level, and it has taken me to a rabbit hole of tax liability, understanding the tax code. I mean, yes. It is insane, because once you start having money make money, you better darn well know where the most advantageous place for you to categorize it. Yes. Right? Do I want it as income? Do I want it as a capital gain? You know, how do I want it? Is there a way to get it and not pay tax on it? Is there a way to get it and pay a deferred tax over a longer period of time?
Well said.
You know what I mean? That's the game I'm learning. And I'm realizing and finding out through the study that it's not a new game. It's not like the 14-year-old boy who discovers masturbation and thinks, oh, I bet dad doesn't know about this. You know, this is these are methods that the rich, the filthy rich, have been using for decades.
A great video in Real Vision, Robert Sherratt from Cresco FinCEN. Ooh, how good was that? I
interviewed Robert. I got him on my show.
How great is that? But what I like is him talking about rates, and it's some content from that, no doubt, was overwhelmingly crypto-centric, but gave a lot of insight into a particular commentary that I have not heard from other persons, the inner workings of the banking system, and that was very insightful.
Very insightful, and to see that they are creating, through DLT technology, the means in which to take traditional assets, get on the blockchain, insure through Lloyd's of London, and create a risk-free 3% savings rate. Well, if the risk-free rate in crypto becomes 3%, you walk out the yield curve, right? Walk out the risk curve and the yield curve. That would indicate to me that if I'm willing to take a larger risk, then I can get gains of 7, 8, 9, 10%.
7, 8, 9, 10% retirement.
That's can you say pina coladas on the beach in Costa Rica?
I can. I can see it. How cool is that? How cool is that? And that's what's emerging.
It's happening right in front of our face.
So I saw a comment. I'm not going to lend out my Bitcoin for now. I agree with that to a bit of an extent. I'm just responding. Simon, well said. So I lend extensively. Two interesting points. One, if your Bitcoin goes from $20,000 to $400,000, you don't owe any capital gains tax. This is just for everyone's knowledge. If you sell your Bitcoin, you owe capital gains tax. If you lend your Bitcoin, you owe interest. You owe a tax on your yield, on your income. If you borrow against your Bitcoin, you don't owe capital gains tax. You have not sold your Bitcoin. So if you bought a Bitcoin and it turns into $1 million, all of a sudden you're a millionaire, but you don't know tax on that money yet if you're crafty, as Jerry has been hinting about the subtleties of knowing your ins and outs of taxes. And the other point was that I myself don't lend all my Bitcoin. It's still the case that not your keys, not your crypto. There is still risk, this kind of party risk, and even more so with the smart contract platforms. We see it constantly, but what's emerging, it's so fast and emerging so fast, is that there's outliers in the DeFi space. The smartest people in the room, just like we see on Real Vision. There's the smartest, the smartest geeks in the room, like Curve Finance and Uniswap. These are the platforms that are setting the precedents and basically building the infrastructure for the future. They're not the Harvest Finance. They're doing all right, but they're not the Dot Finance that's a fork of a fork and a clone of a clone. John from across town decided to make a DeFi platform. These Stanny from Aave, these are the smartest people in the room that are going to basically build the infrastructure of the crypto future. So I do have not your keys, not your crypto on a ledger. I don't lend everything. But Celsius, were they giving 8 and change percent up to 5 Bitcoin, or 6 and change percent? And BlockFi giving you the 6% on up to 2.5 Bitcoin. So there is risk, this counterparty risk. These are centralized organizations, but the same thing that they're doing. And I remember we spoke historically about the concerns, but now we're starting to see the inner workings, and especially we had Robert Sherrod talked about how the yield is generated by these contracts and rehypothecation. They're lending, and the lie that banks only give 0.2%. No, the banks are lending out mortgages at 4%, and they're giving you 0. So if someone personal loans at 7-8%, Chase, I want my 6% on that 8% loan. So Chase is stealing that. But these organizations are lending at 8%, giving 6% to you, capturing 2%. So they got a brand new bank disruptive business, and we're actually getting yield on value that destroys traditional banking.
It is marvelous. So I wanted to bring this up, and that is what your take on the Flare networks and Flare finance that's being built on the XRP ledger and interfacing with the Ethereum virtual machine. What is your take on that? Because I know you don't let these things go by casually. You dive in. I love that. You're like a pit bull. You just get in there and what the hell is going on here? So what's your spin on that, Noah?
It's huge. It has to, as with everything, it has to prove itself.
Right.
What's most fundamentals? You hinted at the beginning of the show, the fundamentals are dead in the legacy financial system. We can't look at revenue streams for companies. But point being is there's extensive fundamentals about crypto assets and platforms and projects and the companies doing this type of work. And so data points, and it reminds me of looking at the crypto charts, how I talk about confluence, and you have multiple data points. You're able to form a cumulative narrative about what's going on, how the growth of it. And one of the most important metrics is TVL, total value locked, is value in the system. It's like 14 something billion dollars on Ethereum. So, and $1.5 billion on Curve, and however many billions on Uniswap. So they have proven themselves, and that has to do with risk tolerance. I will wait to take as least risk as possible. But if there's an opportunity where I could generate yield from one of their DeFi plays, from their lending protocol, or provide liquidity on the DEX, of course. We know, what do we know? Diving into Flare a little bit, it's not Ethereum. It's another chain. Like Cardano is another chain. Like
Right.
Cosmos is another ecosystem of chains, and Polkadot is another ecosystem of chains. So one of the most important things you need with these other chains is interoperability. One other thing I say often is the notion of a disruption. It is almost historically always the case that a disruption, an ongoing disruption, is not disrupted. Um, it took 20 years for Apple to disrupt Microsoft, but Microsoft still owns Enterprise. Lyft is not going to disrupt Uber. Ethereum is not going to be disrupted. It's just that's based on historical, just human nature. It has the network effect. By the time another platform has $14 billion TVL, Ethereum is going to have $50 billion. It's not that it's impossible for it to be disrupted. It's just that it's less likely.
Unless a silo or vertical comes on that creates its own network and network effect. You know what I mean? Yeah.
But they're all going to work together. So we don't need something to be better. What we need is interoperability. And that's the way this entire global system is going to just unfold. It doesn't matter if one is better than the other. What matters is they all work together, because they're all going to disrupt the legacy financial system. So obviously there's tremendous benefits for Flare, the speed of the network. The liquidity, there's just an immense amount of assets, and obviously the way the contracts are written, and obviously the companies involved are going to be different than companies involved with other blockchains. So these are the fundamentals in the way we analyze these types of projects, assess risk.
Exactly. I love it. Noah, I don't know if you've done these kind of things before, but I have this wonderful person. She's a contributor. She comes on to my show at the end or towards the end. She's got her own prepared questions, and her name is Bitta Avenue. So I'd like to welcome Bitta to the stream. She's been patiently waiting off camera. Hi, Bitta. How are you?
Hi, everybody. Happy Friday.
Good evening. A pleasure.
So
how's everybody?
you've been listening, I see in the background. Your thoughts and any questions for Noah? This is a bright guy. I would tap in while he's here. It's free.
Oh, good. So I've heard him say risk on and risk off, and I don't know what that means.
So risk is, let's say, a potential for a loss or a potential for a gain. And as in traditional finance, folks would say you could price risk. So clearly, not to get too technical, but probably the best way to approach risk is relatively, because you have to understand it. And the only way you can understand things, being that we're all humans, most of us, not Santiago Velez, because he's not a human, he's a machine. So is something relative to what we understand. A baseline could be dollars in a bank account. That's a complicated topic, but point being, your dollars are in a bank. It's basically relatively riskless that the dollars will be there tomorrow. The value of the dollars are another story concerning inflation. But so something that could go up in price or down in price is more risky than the number of dollars in your bank account being the exact same thing tomorrow. So that's just a way to think of risk, and risk on versus risk off. Risk on is you're taking more risk than less. Risk off is you're taking less risk than more.
Oh, okay. All right. So for somebody that's new to the space, Like, how do people evaluate risk in general? Like when they get into a crypto, like where do you even start to figure out like what risk a certain crypto or investment has?
I start with a baseline, and the baseline pretty much should be Bitcoin, because the biggest corporations and biggest players in the world, it's a self-fulfilling prophecy at this point. It will be what it is because people are treating it like what it is. It's the new store of value. So anything that is not Bitcoin needs to be treated as increasingly risky as compared to Bitcoin. And then the question is, how do we assess that risk? It's going to be assessed relative to something else, but it's all relative to Bitcoin, but then everything is really relative to everything, so it gets kind of complicated.
So for when you like, let's say you have like a very small amount of Bitcoin, and you wanted to, sell portion of it and then try to come back in when the price drops or something like that, or how do you even calculate what something like that?
So a lot of people that trade. I'm not a trader. So I cannot really give too much advice or insight into it. I've traded, and I've done okay at times, but I'm more of an accumulator, and I want my success to be from making the right investment choices, and the investment choices grow, and ultimately I'm able to produce enough yield from my value. So I wouldn't head down the road, or I wouldn't really recommend the vast majority of people think about buying and selling at the right or the wrong times. I would think of revenue streams. So you want to accumulate Bitcoin, and your work, I work, it's our revenue stream. So the money that's coming in, the thought process should be, how do we take that and what do we distribute it to? How do we place it? And this goes into the topic of portfolio management and position sizing.
Okay. So
let me chime in just real quick, because I think it's a really good point. There is a tremendous amount of risk when you are trading, right? The risk is the market is unpredictable in any short period of time, right? You can try to use technical analysis, and there are things that you can try to implement to give you an idea, but at the end of the day, it's very difficult for traders to capture alpha. Very few do it successfully, consistently. Well, some people will make, some people get lucky and you just happen to hit the timing correct, but most people trading is a losing proposition, right?
Risk on.
Exactly.
Max risk on.
It's max risk on. Whereas the safer risk off play is the accumulation play, especially in any adoption curve where you're low on the adoption curve, where you're at that early adopter phase before any real curve comes into play, where the mass adoption takes place. And in cryptocurrencies, we're all still very, very early.
Also.
So if you're evaluating everything against Bitcoin at this time, for something like XLM or ADA or VET or XRP, like how do you evaluate the risk? Like what elements are you looking for in order for you to evaluate it?
It's a network. Well, this would be fundamentals. So fundamentals tell you what to look at, and then technicals, which I cover on my stream, tell you when. So if you get into an asset that you're wanting to accumulate at the wrong time, it depreciates. That's not a good position to be in over the last. So folks right now are seeing the market. Jerry and I and many thousands of people have been around for years, and the last 3 years have not been pretty. So the when is important, and the what is, they're both important. So TVL, I really love, as I mentioned, with regard to like Flare Network, Cardano, EOS, Tezos, any of the Polkadot chains, the Substrate Parrot chain. I'm getting technical. Point being, TVL. Ethereum has 14 and change billion dollars on the platform. That's meaningful. Now, that means that many people are trusting and using the network, and that's the network effect. And this all really boils down to like psychology. And that TVL is representative that all these people have psychologically agreed that the network is worth that kind of value allocation. So if you're looking at something like a Flare network, it needs to prove itself. It needs TVL. It needs people participating in the network. You can take a speculative position, 1%. That's a gamble until you're able to reduce your risk by seeing that it's heading in the right direction. And then you could edge your way into a larger position as there's perceived to be less risk in taking the larger position. So that's one of the properties, TVL. But you also have the consensus rule. It's like Ripple has great consensus rules, and you're going to have disputed properties left and right. As Raul says, don't be tribal. All these assets are going to contribute to just disruption of the legacy financial system. It's incredible.
All right. So is there anything in particular that you consider that's less risky and when it comes to the crypto space outside of Bitcoin?
Ethereum, because it has the network effect. I mean, everything else that I have a lot of assets, and I'm just risk on. They're risky. I don't. There can be asymmetric returns or not, so you don't have to take big bets. I got this asset, Keeper DAO Rook, it has the most incredible premise. The white paper's breathtaking. So I don't need a large position. If it goes 100x on its money and it's 1% of my portfolio, that changes everything. You take 8% of those gains, 80% of those gains, you recycle it into Bitcoin, you keep 20% in it. If it keeps going up, lovely. Sell on the way up, sell on the way down, accumulate Bitcoin with the risk on positions. Because at the end of the day, when you get to a certain point, a certain age, you don't want to and you don't need to take the risk. You want to be completely risk off because you want to be sitting on a beach with a bunch of margaritas, just paying the bill.
You know, one of the things I've tried to do is make things super, super simple, right? And so instead of talking, like for me, risk versus safety, right? What are the safest bets versus riskier bets? I don't look at a coin's name. It's irrelevant. What's relevant is market cap. And why is market cap relevant? Because it's how the rest of the outside capital markets world sees it.
Yes.
Right? So, for instance, why we're saying Bitcoin is safe isn't because it's spelled Bitcoin. That isn't at all. It's because it has a period of time that it's been in the marketplace. So its technology has been, quote unquote, road tested. Mm-hmm. And it has enough liquidity in its market cap that it's starting to become an investable asset for very large pools of capital. Ooh. Pension plans, sovereign wealth funds, just to name a few. None of the other tokens on the board have that level of liquidity in their market cap or a high enough market cap to be accessible. Mass Mutual could not and would not invest in Ethereum. Doesn't have anything to do with Ethereum's tech. Doesn't have anything to do with the promise of the future for Ethereum. It isn't a large enough market cap. In other words, it doesn't have enough liquidity where it could get passed by the actuaries who make the allocation decisions. Same is true for XRP. Same is true for Cardano. There are 1,000 great projects out there, some of which I have in my portfolio, and I know that I'm 3-4 years away from them having the quote unquote mass adoption effect that I would need to cash out, and I'm okay with it.
Yes.
But you got to understand these things. Retail, what you and I do, we're all playing in a very small pond.
Right.
Well, when this pond gets poured into the big pond and the big fish come, it's going to change everything. So look at your appetite for risk. You personally, what are you okay with losing, or versus a time horizon, right? Can you afford to take 50% of your income and put it in something knowing that you might not get a good sizable return for 5 years? If the answer is no, then don't do it. Scale it back. Is it 40%? No, Jerry, I need that. Okay, is it 20%? No, that's too much. Is it 10%? No, that's too much. Is it 5%? I could probably live with 5%. You've just done a risk analysis. What I just described for you, you and I did a risk analysis based on your income, your investment goals, and we came to a number. But that is risk analysis. You and I just did it.
You know, it's
not
interesting.
a scary thing. Go ahead, Noah.
It gets addictive, saving and investing. And before you know it, I'm like to my wife, can I just buy a little bit more? She's like, no, stop buying. I need cash. I'm like, no, we don't know what, we don't need cash. And then it's like, then more and more your paycheck has to go to investments, and it becomes addictive. And so we have to make calculated, well thought out, informed, educated decisions. And by educated, I mean listening to the smarter people in the room. And I'm not the smartest person in the room. Best said, there's always someone smarter in the room. So the best thing is to listen to as many persons as possible.
So if let's say we always talk about what
He's right.
I'm sorry. I spent 2 years on ramen noodle diet because I was absolutely, my conviction for my investments would not allow me to liquidate anything.
He's so right. Ramen noodle diet. Cut. If you are diehard, you want to retire and you want to achieve some sacrifice. And it's going to be worth
gratification.
Yep.
Go ahead, Bida. Sorry.
Yes, sorry.
No. Actually, Brady also had another question up earlier that was actually pretty interesting that I would love to hear your perspective on that. And yes, that one right there. And I have another question after that. I don't know if you want me to just ask the question now or.
Do you want us to address this question?
Yes.
So no, if you want to, here it is. Would we sell alts for USD then buy BTC or sell the alt directly for BTC?
Depends on the liquidity of the market. First off, I'm just going to, I'm technical and folks might not feel as comfortable with what I am about to say, but stop using centralized exchanges. So just Change Angel. There's a bunch, and obviously DeFi, but this is a massive learning curve. So just a statement I can make, and if you have to use a centralized exchange, you use a centralized exchange. But being informative, centralized exchanges are for trading. So many people. No Freudian. Did I say an F word?
No, he said Jerry.
Oh.
And I may have. I do not know.
So centralized exchanges are for trading. Who's trading? Retail investors aren't trading. They're investing. They're taking positions. So that's why the DeFi space is so interesting. Liquidity pools. You're swapping. You're taking value and you're turning it into something else. No, people are intimidated by seeing order books and the number going up and down, but that's not what people want. So I encourage everyone to look into the concept of DeFi, the concept of non-custodial exchanges where you're taking one asset and converting it to another, and not going on exchanges. And this also is coincidental with the legislation tonight from the Treasury, them trying to headlock centralized exchanges into collecting personal information about persons with non-custodial accounts like a ledger device. They want to track people. But to very specifically answer the question, sell directly to Bitcoin. There's no reason to go to dollars. I'm done with dollars. I have a bias, and I try and not let it negatively affect my investment decisions. But we're human. I hate dollars. Bye-bye dollars. Bye-bye.
I'll answer the question. I have a bias, and my bias is I want to keep as much as I can. That's my bias. And so even the concept of selling anything to me doesn't make any sense.
Yeah.
And so with that being said, if you have an income stream, right, then how you allocate through your whatever dollar cost averaging approach you're taking is one thing. And that's wonderful because you want to continue to accumulate in this early phase of adoption of this obviously monumental technology. This is going to reshape
the world,
value transmission on every level, person to person, person to business, business to business, and every level of financial instrument built will be affected by this technology in one way, shape, or another, and most likely be replaced by it if you want my speculation. So I'm thinking, if I need money now, I don't sell something. I'm going to collateralize a loan and borrow against it. And I'm going to have the interest that I earn always be larger than the interest that I owe.
That's so cool.
When loan to value ratio is no different than portfolio construction or portfolio management. How do you manage your credit portfolio? How many of you out there are paying Visa and MasterCard every month? How many of you out there are paying a mortgage on your home? How many of you have a car note? This was the American way we were taught through the Reagan administration. Consumer, 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 take debt, buy more stuff. Everything's disposable, keep buying stuff, take loans, boom. We are now entering a phase of people getting hip to fiscal responsibility on a personal level.
Yep.
So why don't we take a page out of the rich people's book? Rich people do not pay interest. They earn it.
Yeah.
Now, yes, rich people take loans and there's interest associated with those loans. But guess what? The interest they earn is always more than the interest they owe. There's always a net positive. And this gets into conversations around cost to carry capital.
Oh, that's so good, Jerry. Oh, goodness.
I know I got moist just saying it.
No, the more you say it, the lower it's sinking in, which is making it a lot more comprehensible for me, which is wonderful. The other, I think I heard you say that you would not trade, but you would get other altcoins and then go to BTC eventually, if that's how I'm understanding it. But my question is, if, for example, BTC doesn't have as high as a return as other altcoins, why would I get my altcoins that have a higher percentage return and then convert to BTC? Why would I want to accumulate BTC when the altcoins, if some of the altcoins have a higher rate of return or percentage of return?
Can I jump in that, Noah, before you do?
Yes, of course.
Okay, there's always two sides of the equation, Bitta, when it comes to returns. You're thinking, okay, and I'm making an assumption, and correct me if I'm wrong, but I believe you're coming from the place of, if this coin is going to appreciate 200% over the course of the year, and Bitcoin will only appreciate 30% over the course of the year, obviously the best choice for the most return is the one that's going to go up 200%. That's capital appreciation, and we're all familiar with that model. It's why we invest. Buy low, capitalize it high. Okay. There's another part of the equation, and it pertains to returns, and that is, what if, and let's call it XRP, just so that we can put a name to it, because we're going to talk about Bitcoin and XRP. XRP goes up 200%. in capital appreciation, and Bitcoin goes up 30% in capital appreciation over the same period of time. However, what if on the other side of the interest is Bitcoin can earn you 8% interest, earn you 8% yield, and XRP can only earn you 5 or 4.5 or 3? Because
that changes the game.
It's because it's one thing to be an asset like an equity. It's another thing to be a debt instrument like collateral. Okay. It's that yin and yang teeter totter thing. Bitcoin is becoming the world's pristine collateral. And because of its limited supply, the demand for it is going to earn it a higher return for lending it than something that is readily more available.
The interest rates might actually go through the roof. That's a good point. The demand.
All right, no, you want to tackle her question?
Yeah. Well, this summer was the summer of DeFi. That's unofficially what it was called. Assets were up 1,000%. What goes up 1,000% is going to come down, and it's going to come down just as fast, unless there's a large macro narrative where the world's financial system is changing, unless there's a story why it's going up and it's going to stay up. So retail, much like equities, the stocks, Tesla going up 800% or whatever, at some point there's going to be a correction. And this summer things were up 1,000%. There was a massive correction. So sell on the way up and sell on the way down in risk on. And this is where you protect your gains. So you can take bets. And this is why I say 1% of the portfolio for anything other than the pristine collateral, because it's a massive gamble. And sell on the way up, sell on the way down, accumulate your Bitcoin, or gold, or silver, or if you're into treasuries, what have you.
All right, let's throw a couple of comments here. Jerry, are you say if I borrow 30K at 5%, put it in Celsius Network, get 15%, the loan will pay itself off? I would have to put those specific numbers in my spreadsheet that I've designed. But the idea is that you earn more interest than you owe on the loans that you take. Yes. That's the basic premise. The actual numbers, when I get the spreadsheet available for public consumption, I will, of course, make sure it's available to all the subscribers on my channel. There was another one here too. Jerry, why do I want BTC when it's worse than XRP in every way? Casino Pro Coin, you're actually not correct. What you and I believe about something is irrelevant. It's what the world or the market thinks. The world has decided Bitcoin is a store of value. And it's not just human beings on a retail level. It's every level of the food chain and capital markets is decided with the exception of a sovereign nation putting it in their cash reserves.
So XRP is better with regard to speed and arguably its consensus mechanism and arguably contracts and functionality. Digibyte's better than Bitcoin.
XRP cannot touch Bitcoin's jockstrap when it comes to liquidity.
Exactly.
And demand in the marketplace, as evidenced by the market tells us every friggin' day. When I look at it, Bitcoin's at almost 23 grand. XRP still struggling at 50. Bitcoin surpassed its all-time high. XRP's at 56 cents. I love XRP. It's the largest holding in my portfolio. And I think that once it gets through, I think in 3 years, XRP will melt faces.
Yeah, I agree.
And I'm basing that off of a network effect curve that we went over with Sergio Velez. Look at Bitcoin's lifestyle. Look at XRP. XRP's 3 years behind Bitcoin. So extrapolate 3 years from now, what kind of market saturation did Bitcoin have? XRP could very well have the same market saturation because it's all based off of network effects. It doesn't matter the symbol in front of the coin. If it's following to the trajectory on a network effect trajectory, then it's most likely going to act similar.
Isn't there something important about the whole melt faces concept? What goes up comes down. until market stability is reached. And this comes into liquidity events. If something's going straight up, that's a liquidity event. That's where the sell side pressure doesn't equal the buy side pressure. There's an imbalance in the market. So then all of a sudden, a huge amount of people made a huge amount of money. All of a sudden, the overwhelming buy side pressure turns into sell side pressure. And now it flips and comes down. And then it flips and goes up. And eventually, and this is what happens, that there's a large ecosystem of exchanges, then you start to have arbitrage. So as if picture Ripple going up 1,000% on one exchange and 800% on another exchange and 1,200% on another exchange, then you have arbitrage between exchanges, and people are trading up and down. The price is going, and it starts to balance itself off across the exchanges, and that is market stability. If something goes up really quick, it's going to come down really quick.
Yeah, and that's true. We're in a nascent market. We need to remember that. We're still so early, even though in the last 3 years, I feel like I've aged 8 or 9 to 10 years. But that's just because I've totally immersed myself in this space. I'm looking at the clock. Noah, normally our shows go an hour. However, we've had such incredible guests the last month, 2 months. They've been going longer. Can I get another 15 minutes out of you?
I like talking. It's
all right, folks. Get your stuff up here. I want to just acknowledge, Stephen. Thank you. You make a great point. Throughout history, most successful people always surround themselves with the brightest minds. We have access to information like never before in the history of man. As we, the hive mind, right, the crypto universe, continue to interact with each other, we're sharing and we're learning together. The hive mind gets collectively stronger, smarter, faster, more nimble. This is a huge advantage for us relative to those that are still saying that digital money stuff. No, I'm okay. I got my Tesla stock. I got my Robinhood app. I'm burning it up on Robinhood, baby. Okay, no problem. Bitta, anything? I know you got a notepad full
I
of
actually
stuff.
I'm done with my questions. It's been very very informative. Like every week, my knowledge of what's going on is kind of growing, and being able to merge them together has been very valuable for me. So yeah, it's been amazing.
It is. I'll tell you what, this guy here, Mr. Noah, does a show every day, right? It's about 11:30. Well, at least Monday through Friday does a show every day. This would be a guy you want to get and see if he'd be more than, come and join you on your Instagram thing. She does an Instagram show and she's bringing new investors along.
I'm more than happy to talk.
He's a practitioner. He is a practitioner.
My goal is just to help. I've learned a lot over the last couple of years, and I do this for myself. It's for me, and it's I think it's worthwhile for folks to hear my experiences. And if anyone's willing to listen, I'm always happy to share what I've gone through. I bought DigiByte at 14 cents and watched it go to 0.2 cents. And you don't want to do that. Trust me.
When I got into XRP, it was February 2nd, I think, 1st or 2nd of 2018. So all that stuff had just happened with the big monster. And so I got it. I started to get in a little bit. My first position I got in was $1.08. And because I come from, I came from traditional markets and I'd seen the curve come down, I was convinced dead cat bounce, this thing's going to bounce right off $1, get right back up into 2, because what I read about the project is this is going to change the world.
It will.
Well, all that stuff is true. And it's still true. Matter of fact, that case is only getting stronger every day. However, there were things I did not understand about markets. There was a tremendous amount of financial literacy I did not have. And I learned the hard lesson on a pay-as-I-go basis. You know what I mean? And so, Noah, between you and me and Bida and the rest of this, it wasn't until a month and a half ago that I finally got net positive, became profitable in my position.
Okay.
Good to hear.
I spent 2.5 years eating top ramen and beans and rice and begging on
from it
for plantains and scrap papaya. Yeah, it was tough. It was tough.
But you learn from it, and you will never experience that again. And the thing that I could say, Tor, with that is picky to buy, quick to sell. You want to be very, very picky whenever you allocate your value. And if it goes up quick,
sell. Now that quick to sell, I'm gonna challenge that with this method, and I'll share it with you. We'll get on a Zoom call one afternoon or something, and I'll walk you through this, what I believe is an extremely solid strategy in this space for the next 5 years. My honest opinion, I'm just telling everybody, this is where I'm at right now. If you sell any of your crypto in the next 5 years, you will most likely regret it later, because we can't comprehend this is really going.
Yeah.
None of us can. We've never seen it. We've never lived through it. We've never viscerally, emotionally, tactically.
No one has. Quadrillion.
Experienced this. And selling for profit, although an excellent model from the old way of doing things, with this new information, we make better decisions to produce better outcomes. And I'm telling you, there are ways to receive capital, right? Enjoy some of the capital. So you could picture it in your mind. I'm going to take some profits. I'm going to take capital and I'm going to have some fun with it before 5 years. Mark my words, but not one single digit, not one single coin will get liquidated to do so. Stay tuned, because that journey is going to unfold in front of your eyes in real time, because I'll share it. I don't care.
We're going to be here. We're going to be here, boys and girls. There's that carry trade, man.
We're here for the long run.
Anybody, I'm a risk-off carry trade kind of guy. I'm a take 4%, borrow at 4%, and earn 30%. I'm just saying, because that's what's going on right now, boys and girls. And I talk about that on the show. I think Jerry probably seen me talk about that a little bit. And it's real. It's so bear in mind, the first thing a person would say is, that's not sustainable, or how does that work? But it's real. You get an asset that has a value that's equivalent to 30% interest. Now, that's a whole story of that is an asset that appreciates and depreciates. But the value of that asset at the time you received it is 30% on a yearly basis. So now it gets complicated, because what do you do with that asset? Maybe you convert to Bitcoin. Now you have more collateral to get more return. And that's called the carry trade. And guess what? The reason why I consider it relatively risk off is because if the carry trade fails, meaning if the interest you're getting does not exceed the interest you have to pay, that's when you exit the trade and you look for another opportunity. Now
that is some advanced level. That's the shit JP Morgan and
it's true.
Goldman Sachs are doing these, and that's a fascinating topic. Matter of fact, Noah, you should do a standalone vid on that, not a live stream where you got all these people in your face about it, but really walk through the principles and characteristics of that exact function, because it's a process. It's a B, C, and B has a continue or stop. When you get to C, because you've gone to A and B, you're ready for C. C has okay, we continue or we stop. I mean, it's a very systematic process, but filled with so many little nuances. And you're a great educator. Tune in, watch it, probably watch it 5 times because that's how I do it. I got to take a notepad. What did Noah say with the friggin' term? Okay, write it
You know,
down.
like George Gavin with his whiteboard.
Yeah.
Yeah.
How good is George? He's so good. My God.
I like his shows too.
Oh, he's
Yeah.
wonderful.
You
So
and
is
I.
your channel on YouTube?
I'm a YouTube guy. Noah Seidman. Google, YouTube, Twitter. All you have to do is search, and I'm everywhere.
All right, I will definitely reach out
His
because
name
I would
is
love
his
to have
brand.
that conversation.
Yes.
His
Yeah, I
name
have that written down.
brand. Yeah, Noah Seidman is his brand, and it doesn't matter if it's Twitter, YouTube. It doesn't matter. It's Noah Seidman, just like Jerry Hall. I mean, that's who I am on everything. It makes it easy for people. Tips for you folks out there that are considering making content. If you're considering having a brand that's going to be on across different platforms, have the same name. Have the same name everywhere. Yeah. Have your email address. Your email address, all your platforms have the same name so that you can truly employ a network effect and leverage these platforms against each other and build an audience like Noah did.
Right. Yeah, that's awesome.
Heirloom. See you tomorrow. No, wait, Monday. It's tomorrow Saturday.
And it goes for everybody here that has Instagram. If anybody wants to come on and like just have a conversation about what everybody's doing on the crypto market, I would love to listen. I just want to have like kind of like discussions that makes it a lot easier.
Time? Like this show is every Friday night at 9, so people kind of know.
I don't do regular time. Sometimes I get messages. Everybody's asked me to like, sometimes like we'll try to do it like on all Thursdays, and sometimes I try to do it right before this show. So then I'm telling people, hey, in a few minutes I'm about to start over there, so come to the other side.
Thank you.
Yeah, and then I post about it. But I want to get to the point where I do it on Thursdays and then on a Friday. But we've had. Sometimes people will call me and we'll just get on live. Literally, that's just how we do it because everybody has it. They get notification as soon as I'm on it.
That's how the young people do it.
Yeah, they just all come on. So,
well, no one grew up in a TV guide world where you picked up the TV guide, you went and looked. Okay, what's on at 8 o'clock? Okay.
Yeah, we did.
Yeah, ours is whenever we're free, we just hop on and everybody just jumps back on it. So that's how the Instagram world works.
You young people, your high-tech, high-flying world in a cell phone lives. I'm jealous.
It makes it complicated sometimes because a lot of the people that follow me speak are my native language. So I'm trying to, because they want to speak in the native language because they want to make fun of my accent. But then I keep speaking English. So now that I have English speaking people that don't speak the other languages, it makes it a little complicated to stay on English because other people want to have conversation in other languages. And sometimes it gets complicated. So.
Right on.
We do the best we can. That's all we can.
Those in the chat that are acknowledging the talent that is Noah Seidman, and for those of you that have been in my audience that are saying that you're subscribed to him, it's going to be time well spent. For those that continue to tune in every week, right on. Noah, part of my show at the end, I ask you and Bitta if you'd like to stay for a quick after show, and then I put you backstage and I bring in my producer for final thoughts. So I want to give you and Bitta a chance for final thoughts before I bring in the internet's best producer, Brady, to close the show out.
Bitta, after you.
All right. My final thought, I guess, is I am definitely reconsidering my exit strategy and not wanting to sell any of my crypto that I have already put away. But now I'm getting a little greedy, so I don't want to give them out anymore. So there you go.
Nothing wrong with that.
So I 100% agree with what you say about not exiting. I'm sure you agree with when irrational exuberance occurs, which we have seen where the retail market just sends it into a frenzy. We saw it this summer. Many participated, many didn't. Many of the old school names on Twitter that were around in 14, 15, 16, 17. They're like, what's going on? What is this DeFi? And they literally watched it all unfold, but it was something they experienced back in 2017, 2014 also. It was the irrational exuberance. Assets going up 1,000%, 1,500%. What goes up comes down. For many assets, you don't want to sell. You want to accumulate. As exactly as Jerry says. But when there's a period of irrational exuberance, what goes up will go down just as quick. And the fundamentals tell you what to look at. The technicals tell you when to look at it. And technicals I know can be overwhelming. I do go over technicals on my show daily. But they're so obvious. It's just so obvious when something is going to be trending up or trending down. So I don't trade, meaning I don't look for opportunities to get in and then get out. But what I like to look for is like significant trend changes, when it's going to start going up for a period of time, when it's going to start going down for a period of time. And man, XRP has the most obvious trend change. It's so incredible to look at in the chart. It's like, yeah, the story
explode up, then nice
yeah,
down climb. Explode up for a day,
yeah.
nice down climb over a week or two. Explode up for a day, nice gradual down climb for 3.5 fucking years. Oh, excuse my language.
But yes, but that's what just happened like in the last weeks. Was it just shot up above the weekly 200 EMA, and that is a massive multi-year story change. So you have to be careful. You have to consider your risk. Don't take too much risk. Accumulate yield-bearing assets, and always seek out other people's opinions and advice. There's always someone smarter in the room. Real Vision is crazy. Jerry's got some incredible guests. Santiago Velez is a machine. and stop by the stream. Ask any questions. I'm always available on Twitter, and I'm always happy to talk. It's a curse.
Right on, Noah. Thank you so much. I'll see you backstage. Brady, bring yourself in here, baby. Give me some final thoughts. Brady's collecting himself. So, wait. Oh, there he is.
Slowly figuring it out, one click at a time. And then the computer freezes. Awesome. Wow, this was quite a learning experience, and it's very interesting that the mind frame that I've been slowly crafting and molding and changing with Jerry's help and Nick's help and Bitta and listening to everyone and thinking about what everyone else is thinking about has brought me to my final conclusion, and I'll try and make it short and sweet. And Jerry, let me know if it doesn't make any sense. Here it is. Understand the market and what it believes before you add your own. 3, 4, 5 months ago, I may have been thinking, oh, all these assets are cheap. They're all, I can get much more units for my cost unit, or my, the ratio is a lot higher. Whereas Bitcoin, oh, you get 0.000 whatever. But if you want to look at the market and you want to look where the macro eyeballs are looking, pristine capital or pristine collateral has never, I can't say it's never been like this because we've had treasuries, but as we found out, we can make more treasuries. So if we have collateral that we can't make more of, how much is that worth? And I always think, or I still believe, and I always have believed, it's gold without its atoms. So you get the price, you get the history, you get the ethos of gold, but it's digitized. Obviously, there's no correlation to 21 million kilos or 21 million bars of gold. So your mind sort of has to stretch past that gap and understand what finite means. But essentially, if you told everyone, hey, all the gold in the world, we're just going to, shift it over to Bitcoin, and it's just going to be more pristine. It's you can't inflate it. You can't mine it. There's no more of it. And the number's just going to go up. And so XRP is cool and it's great, but that's a year, 2, 3, maybe 5 down the line. Bitcoin now, mucho gusto. I'm buying Bitcoin now. And that's my story, and I'm sticking to it.
All right. Hey, put yourself in the green room and I'll be right there with you. So I wanted to address my final thoughts specifically to Stephen. Stephen, you're a wonderful contributor on the show. I really appreciate seeing you and your comments. And I think it's really important that every single person takes this in, right? And that is, each and every one of us is different in our goals and our ability to generate resources or the need to restrict resources. We're all different, and we all have different visions for what we want in our lives. So with that being said, there is no one investment strategy that is better than any other investment strategy. The very best investment strategy is the one that you have put the time to learn, educate, test, back test, rethink, and are willing to change as new information comes in. Those of you who follow my channel for the last year and a half, I've got an hour-long exit strategy that I spent months working out every great detail, understanding the tax liability, understanding market dynamics as it pertains to the credit world. And I had selling points. I had prices I was going to sell, and I was willing to pay the tax, and I was willing to do this, and I was willing to do that. Well, new information's come. I don't want to pay tax if I don't have to. I will because I'm a good citizen. But if I don't have to, I'm not going to. And I think I've stumbled on a way. I'm calling it the collateralized lifestyle. It may not be right for anybody else but me. But then again, my wealth, as large as it's going to be, isn't for any of you. It's for me. That's why I own and am responsible for my investment strategy. And that includes the exit part. You will do the same. Take in information, feel what's right for you. Talk to people, bounce ideas, create spreadsheets, work out numbers, forecast things. Do that work now before the actual dollars or digits in your wallets or accounts are so high that emotions come into play. Many of us are going to experience wealth like we never have before. If you do the preparation ahead of time, that's something an obstacle you will not have to overcome when you're dealing with the, oh my God, look at my portfolio. This is, you know what I mean? Do the work now. We're doing it together on a weekly, daily, sometimes hourly basis. So for those of you that have hung around to the end, I want to say thank you so much for tuning in to Market Conversations. The support of the Jerry Hall video YouTube channel has been wonderful, whether it's interviews or my Beyond Moon series or these live streams. Your engagement means a lot to me. And I very much appreciate that this audience is growing slowly, that we're not doing some kind of hype show and getting 25, 30,000 people to come because they think XRP is going to be $25 for Christmas. We're trying to learn and become better investors and produce better outcomes. And for that, and everybody related to the show, gracias and pura vida. See you next week.